What if I told you that every single business on the planet, from street food cart to trillion-dollar corporation, tells the same story using the same records? Not hundreds of reports, not complex spreadsheets, just three documents. And once you understand how to read them, you will never look at a company the same way again. I'm going to break down all three financial statements in less than 10 minutes. So let's get started. Welcome back. Today, we're going to cover three core financial statements. A lot of people learn them in this order: balance sheet first, then the income statement, and then the cash flows. But I wanted to flip that because there's more intuitive way to think about it. We are going to follow the money. How a business makes it, how it actually moves, and what's left standing at the end. So that means we're going to start with the income statement. But first, let's understand what exactly are the financial statements. So financial statements, if you have to technically define it, it's an official report that summarizes how a business has performed and where it stands financially. They are produced at the end of each accounting period. It could be typically a month, a quarter, or a year. And they're used by investors, banks, and leadership to assess the health of the business. Okay, now you know what the meaning of financial statement is. Let's now walk through each one of them in that order I mentioned earlier. So let's first talk about the income statement. This document answers one question: did the business make money? It covers a range of time. So say for example January 1st to 31st to December, and it tracks two things: revenue and expenses. Revenue is the money that the business earns from doing what it does. Like a gym earns revenue from membership, a law firm earns revenue from clients billing, a bakery might earn income from selling breads. Expenses are day-to-day cost of running the business. Salaries, rent, raw materials, software tools, marketing, basically everything it takes to keep the business operating. Here is a very simple example. Imagine a landscaping company brought in 500,000 of revenue last year. Between labor, equipment, fuel, admin costs, they spent $430,000. That leaves $70,000 in net profit, and that is the bottom line. Net profit is what's left after everything is paid. It's a reward for running the business well. The income statement is also called as profit and loss statement, or just the P&L. Some companies call it statement of operations as well. Different names, but exactly the same document. But here's a catch: profit isn't cash. A business can show healthy profits and still struggle to pay its bill, which is exactly why we look at the cash flow statement next. If the income statement tells you whether money was made, the cash flow tells you whether money actually arrived. The difference comes down to how the businesses record transactions. A method is called as accrual accounting. Under accrual accounting, revenue is recognized when it's earned, not when cash is received. And expenses are recorded when they are incurred, not when they are paid. So, say for example, if a consulting firm invoices a client of $80,000 in the month of December, the revenue is recorded in December, even if the cash arrives in February. But if the client pays in February, that cash doesn't show up until the following year. The cash flow statement exists to bridge that gap. It tracks actual cash, that is, the money physically moving in and moving out of the business over a specified period of time. The statement is divided into three parts. The first part is operating activities, and this section shows the cash that the business makes or spends throughout its everyday operations, like selling products or services, paying suppliers, and collecting money from customers. It tells you whether the business can generate cash from what it actually does. The next part is investing activities. It covers cash spent to grow or maintain the business. For example, cash spent for buying equipments, investing in new projects, acquiring another company, or selling assets that are no longer needed. The last part is financing activities, and this shows how money comes into the business for funding and how it goes back out through loans and investors. When you add all these three sections together, you get the net change in the cash for that period. So if the business started the year with 3 million cash and ended in 5 million cash, the cash flow statement shows exactly how 2 million increase happened dollar by dollar. So now we know two things: how the business has performed and how cash actually moved during that period. The last question is, Where does the business stand after all this? And that's what balance sheet is all about. Balance sheet is a snapshot. Think of it like a freeze frame of the business at a single moment in time. It shows two things: what businesses own and what it owes. So what it owns is called as assets. For example, cash in hand, inventory, property, equipment, and debtors. What it owes is called as liabilities and equities. Liabilities, think of it like debt payable to outside parties, bank loans, unpaid supplier invoices, could be tax obligations, basically anything that the business needs to pay back. It includes the money they originally put in plus any profit the business has kept over time instead of paying out. And this leads to the most important rule of accounting, one that always holds true. Assets is equal to liabilities plus equity. This means everything the business owns is funded in one of the two ways, either by borrowing money or by owner's investment. And that's why the balance sheet always balances. Think of it in this way. If a manufacturing company has $10 million in asset, 4 million in liabilities and 6 million in equity. That 6 million basically represents what the owners would have left if the business sold everything and paid off every debt. In simple terms, that's the business net worth from the owner's point of view. Now let's pull all of this together. We started with the income statement, which shows revenue earned and expenses incurred over a period of time. It answers the question, was the business profitable? Then we discussed the cash flow statement, which basically tracks the real cash moving in and out over the same period, split between operating, investing, and financing activities. And what does it answer? It answers this question, does the business actually generate cash? Finally, we covered the balance sheet. This is basically a snapshot of assets, liabilities, and equities at a single point in time. And what does it answer? What does the business own, owe, and what's left for the owners? So the three statements, three angles, one complete financial picture. Investors read all three, lenders would require all three, and now you understand all three. So if you want to go deeper, let me know in the comments. I'll make a detailed video for all these three financial statements individually. Subscribe if you find this useful, and I will see you in the next video.